Okay, now that we've discussed time frames and how they're important, again, just to repeat it, you're using the different time frames to analyze different data based on time and the sentiment of the market during that particular time. When you look at the higher frames, you're seeing cleaner, more trustworthy information, information that you should trust more to invest your money with, right? You're doing your due diligence. That's what you're doing when you're breaking down, aka analyzing the chart. What type of analysis? Not fundamental analysis, which is the news, economic calendar, and all that stuff. It's technical analysis. You're looking at the technical, the movement of the market through phases. Now, let's begin more meat and potatoes of what you got to know. Now, remember, the video you just watched and this video, they're going to be pretty much what you do during your career. People think that me, right? They look at me, they follow me on IG, and they think that I have some holy grail secret. There is no secret. I've just been doing this for much longer than you and have accrued way more hours. I've taught people, I've done this thing. I'm just solidified in who I am as a trader. What separates good traders from bad traders is simply their ability to apply in moments of not understanding what's going on. Their ability to step away from the chart. The things that they do to keep the money. Okay? But for you right now, you need to start somewhere. You need to be able to find a way to gain experience. We need to start getting you on these charts with some sort of understanding and a real approach. So the conversation begins with what the hell are we analyzing, right? How can we start to make sense of things? Now remember, what are you looking at when you look at these candles? You're looking at the sentiment of the market, meaning you're looking at the flow of the market, whether the market, the money, big banks, institutions, whether news and all that stuff put together is causing this market to be bullish or bearish. When you're looking at a weekly, you're looking at weeks worth of information telling you that it's really bullish, right? The market is creating bullish movement. When you're looking at an hourly, you could just be looking at it for the last couple of hours. This market's been bearish, and that's it, okay? And it has an area of respect, and that's it. So when you're breaking down the market, your biggest concern is always going to be, what am I trying to do here? But let's begin with this real quick concept. All right. So when you're looking at the candles, what you're actually looking at is the flow of the market. Like I said, that flow consists of some phases. I mean, there's different terms for it, but we're going to dumb it down and we're going to keep it simple. You'll hear words like accumulation and absorption and exhaustion and a bunch of other stuff. It all basically means the same thing. So let's keep it simple. It begins with trending. Everyone knows this one. Trending. When the market is very one-sided. So let's read the little definition here. Again, what did I do to find this? I Googled it. Now, while I've been making this little course here, I realized something. Googling things isn't that easy. I remember that's why I started coaching people in the first place. Because Googling things, all this crap comes up and you don't even know where to focus. And I know that I thought about that when I was making this course, but it really made sense to me when I started really Googling things to bring up for this course and like pictures and images and stuff. There is so much crap out there. So let me help you by telling you this before we continue. Be careful how much you spend when it comes to education. I'm not talking about price point here. I'm talking about, let's say you get my course. And let's say my course is too tough for you. Let's say you're like, oh my man, he wants me to actually analyze charts. He wants me to actually think. No way. If you go out there, you will find people who will prey on your weakness, which is your laziness, your stupidity, and they will charge you and charge you and charge you and create new systems and create new shortcuts and create all this stuff. And basically what that ends up doing is it ends up burning you out. You run out of money and you're gone from the game. In trading, you can learn how to do this with just understanding what the hell it is, right? What I'm teaching you right now is what I use. There is no secret. There is no super secret sauce. That is not something that I have. I am just really good at what this is. Knowing the phases of the market, knowing how to enter, following rules, proper management on the risk, proper management on the profit, proper management on the loss, and psychologically being able to control myself in moments of tension and in moments of bliss. When I made a lot of money, you got to know how to control yourself in these situations, in good and bad. Experience is the separator. Psychology is the separator in this game, not a magic tool or a magic indicator or a magic system or a magic educational platform. The reason people come to me and pay me what they pay me when it comes to one-on-one coaching, which is a premium price, is because they're taking my time from me and they need my time to focus on them and their trades and all that stuff. But they're not learning any magic. They'll all tell you. What they're learning is they're getting a psychological smackdown. They're getting hit with reality of who they are as a trader and breaking down things that they can actually apply to make them better. When they join my group, they're watching people trade that are just like them but are doing better than them. And then they're realizing, okay, these people are just figuring out ways to just be sharper and just be better and just be one step ahead. It's not a huge, wow, this guy just came out with the greatest system on the planet. It's not that, right? It's just people with experience who can show you how to apply it. Which brings me back to all this Googling stuff. Googling things, I realize like people are just selling a whole bunch of crap and people don't even know where to look. So that's what I'm doing here. So I found this in an article, I think it was, and basically it breaks down the phases that we all know. It's trending. If the price rises over a period, it is called a rally, a bull market, or just an upward trend. We've spoken about that. If the price falls continuously, it's called a bear market, a sell-off, or a downward trend. Different trends can have varied degrees of intensity. In the next section, I have no idea what to talk about. We will learn the individual facets of trend analysis. Okay, so what is a trend? How to pick that apart? Cool. Let's go look at that. A trend. Pretty simple. This is the easiest way for you to remember how to break down a trend. When the market is creating higher highs, okay? Let's go to the market is creating higher highs, right? So that is a high. That is a high. The time is irrelevant right now. We just need the visuals. Okay? That is a bullish trend. What makes it a very good, solid bullish trend is the fact that it's also creating higher lows. So what I'm showing you here is that the market is ascending. It's going up. It is creating, what we're about to pick up is a trend line. It is creating a ugly but still applicable trend, okay? It is ascending, going up, bullish. It is creating higher highs and higher lows. Bearish, what is that? It is creating lower highs and lower lows. Okay? Bullish, what could it also be? Creating higher lows alone. Now, if the market is creating both lower highs and lower lows, it is really freaking bearish. Okay, that is a strong, intense trend, especially if it's happening on a higher frame. If the market was only creating lower highs and kind of flat on the lows or choppy lows, then it's a weak trend. And we'll talk about that in a second because that coincides with other phases. What you need to learn right now is your eye needs to start gravitating towards how the market is closing those candles. Remember that conversation? Closing those candles. Is it creating higher lows? Right? If it's not creating higher highs, then it's a weak trend, and you need to be a little more careful, maybe a little more patient with your risk. If the market is creating higher highs, and this is, by the way, this is a very ugly trend. I just used the example that was in front of me. If the market is creating higher highs and higher lows, then it is a very strong bullish trend. If for whatever reason the market is only creating higher highs but no higher lows, then the market is weaker and it's going to take more time for that thing to move in the direction that it's supposed to. All right, these are just Very easy concepts. I'm not trying to show you perfect world scenarios. We'll worry about that later. Okay? Next phase. Corrections. Corrections are short price movements against the prevailing trend direction. During an upward trend, corrections are short-term phases in which the price falls. As we will see, the price does not always move in a straight line in one direction during trend phases, but constantly moves up and down. Okay, that, my friends, is what you see in the market a high majority of the time. All right, corrections. The market is really, really bullish, corrects, continues its bullishness, corrects. You look at any chart, you'll notice something. It never moves in just one direction, ever. Even in dagger drops. This is March. You know what was happening in March 2020? The world was imploding upon itself because we thought the world was over because of coronavirus. Okay? So the market, even though it dropped like this drastically for thousands of pips, by the way, we took that in the group and we made a lot of pippage. The market still had little uptrends. Remember these wicks? Right? We covered this in the last video. That tells you the market was here at some point. Let's zoom in. Look at the wicks. All right? That's telling you something. Pay attention. It's telling you the market was here, closed, came over, came up here, right? So it's not a smooth drop. And you can't ignore these little uptrends. That right there is 84 pips. In the game of trading, sharpness matters. If you're not sharp, you're in drawdown all the time, and honestly, you're gonna be screwed when it comes to being able to manage through multiple charts. You gotta be sharp. You can't find yourself in hundreds of pips of drawdown before you can catch 10 pips. If you watch the beginning of this series, we talked about risk to reward. We talked about drawdown. We talked about if you want to catch 80 pips, you gotta risk 80. You can't do more than that. So being sharp is important. Now, what I want to show you here is correction, okay? So even in this huge downtrend, there's still a little bit of correction because the market always needs a moment to kind of refuel itself, to regather itself, to allow the big money to get more entries in there, to gain more liquidity. This is advanced concept. We're not really going to go there, but I just want to throw that at you. You have to understand that the market will never move in just one direction. Now, let me throw, if I could put a little alert here for you, don't just think that the market is going to do that and automatically that's an opportunity for you to sell and buy. That's stupid. Think about this for a second. Why would you fight the flow of big money? In your brain, you should always be geared towards, is this the way the market is actually flowing, or am I fighting the flow? Am I fighting the current of the market? You don't want to fight the flow. Here's why. You'll find yourself in way more losses, and you have to be that much sharper. When you are against the trend, you got to be way sharper because there's less room to make mistakes. When you're trying to be with the trend, you'll fall into more wins by accident or close calls that the market ends up fixing for you because the market is working with you. I know that's easier said than done. You may not even know that right now, but it is. It's easier said than done. But in your mind, as you gain experience, every trader goes the route of looking for big reversals. When they see major moves in one direction, they always think that the market's going to fill the gap. Bullshit. That's not the way it always works, okay? Don't fall into that trap because, see, here's what you don't understand. If you've been trading long enough, you learn something, a vicious lesson. You are not in control. And no matter how much you know and how much you think you know and how experienced you are and how much you've made, take it from my side. I've been doing this for a long time. And when March 2020 hit, I have never seen anything like that in my life. Guess who else hasn't seen anything like that in their lives? Any trader that's been alive at any point over the last 60 fucking years, 100 years. That was some historical shit, what happened in March 2020. The market will always humble you and surprise you. But guess what? Through all this historical movement, we still profited. We destroyed the market. It was insanity. It was amazing. But it was simply because we're prepared, always thinking ahead, always planning, never greedy, always smart money. You want to invest into the market intelligently. You don't want to try to flip all the time. You don't want to try to worry about, oh, let me just get into this little trade here. I just need $100. Don't be that way. by you diminishing your goals and your targets and the quality of your trades for a little bit of money, you're missing the point of what's in front of you, which is way bigger situations than anything that you could understand right now. And that's that. All right. So corrections. We got trends. This would be a trend. Correction. That would be a correction. Don't worry. We're going to do this on other charts. Even this right here. Any movement that comes after a major movement that is in the opposite side is considered a correction or a retracement, which is a more popular term and the term that I use more. Retracement, correction, it's the same shit. And those are all details you can analyze. Here's why. Let's say I'm trending. Okay, I'm here and I'm trending and I trended down 360 pips. I have a slight correction here, right here. Okay? And then the market finishes the trend and comes back. Look at that resistance here. If I take that sell, that's 182 pips. If I think the market is bearish, then I'm trying to go with the trend. That's what I'm doing. What else am I noticing? I'm noticing the market is creating lower highs. What did I just tell you? That means that it has some bearishness to it. Now, obviously, the market eventually caught a low. Right? It's creating lower highs. It finalized the low, started coming all the way back, retested an old high, and then took a major shit all the way down there. Okay? That was the coronavirus. So, what am I showing you here? I'm showing you the phases of the market. Now, I want to say something here. I know what your brain is saying automatically. Well, how do I know it's going to stop there and not keep going? How do I know that? You don't. Details. This is the daily chart. This is days and days of work. You're not over here, oh my God, what I got to do now? Like driving yourself crazy. You know how like on TV, you see the stock market and they're all like sweaty, bald-headed, like middle-aged guys who are like just screaming, buy, buy, sell, sell. That's not what you're doing. This is days and days of activity. We already broke it down as far as you knowing that there's details within the details, or as we like to call it, waves within waves. So let's find that market right here. All right, that's what we were just looking at. See, this is a 4-hour chart. Look how many candles, 4 hours at a time, this thing created. Sooner or later, you would have figured it out. Maybe you would have figured it out if it broke back over an old low, right? Maybe you would have figured it out after a day and a half of bullishness. You would have figured out that you had to slow your roll if you know what you're doing, okay? You don't know when a trend's over. That's the part you don't know. You could have great targets. You could have, a place where you believe the market's going to turn over. That's just called technical analysis and planning. But at the end of the day, the market makes that decision, not you. So your job is to not react too early. That's your job. And your job is to protect your profits. If you're in from up here, you should be protecting your profit. You should be making money, right? You should be trailing your stop loss. There's different ways you can manage that entry. I don't know what your trading plan is. That's not my job here. My job isn't that right now. My job is to show you that in this market, there's trending and there's correcting. Okay? Let's see the next phases. Consolidation. Now, we're going to just finalize this here. Consolidation. Consolidations are sideways phases on our charts. During a sideways phase, the price moves sideways in a clearly defined price corridor. Basically, a high and a low. All right? So, let's talk about consolidation. Let's go to a daily here. Let's go back to the right side. You notice that at the beginning of the first video, I drew on this chart. And I just said, look, let's go to the H4. Okay. There's consolidation happening here. Remember I told you that the market has these 4 phases? 2 of those phases are your most common. Breakouts are not one of them, and trending is not one of them. It's consolidations and retracements. Look at a chart. What do you notice? It's diagonal, okay? It's not one-sided. It's not a straight line up. It's not a straight line down. It's a stepladder effect. It moves in what we call channels or trend, or in channels. We'll use the word channels. I'm not even going to kill you with terminology, right? Channels. It moves diagonally. In order for that to happen, there has to be a whole lot of up and a whole lot of down, a whole lot of down and a whole lot of up. The market has to move and then engulf itself, or else it can't move diagonally, right? It would just be a straight shot up, a straight shot down, a straight shot up, right? It would just be one huge, what would look like a like one of those heart monitors or something like that. Okay, so we got three phases we covered so far: trending, we got correction, we got consolidation, which means there is a hard low and a hard high, and the market is not budging from there. Now, when the market breaks out of that, that's the obvious fourth phase, a breakout, which is honestly the precursor to a trend. Okay, a new trend. That's what that is. Let me show you some examples of that. Right here. You see that high? You see this low? The market from July the 8th to July the 20th was just bouncing around between a high and a low. Bouncing around, bouncing around, bouncing around, until finally it used that old high as a new low and started the breakout. Okay? And then it started creating higher highs, which is the brand new trend, and then this thing was freaking gone. Okay, so a beginner trader's mind is always going to go towards this. It's sexier, trending, breakouts. They guess the breakout, they chase the trend. That is what they do. They believe that every single market is going to just keep going no matter what. No. The way that I teach people, and here's some more sauce from you, the moment that I grab a new trader, a brand new trader, the first thing I tell them is approach the market like it's never going to go anywhere. Always. If you see a low, work the low as a buyer zone. If you see the high, work the high as a seller zone. You would rather lose that way, right? You would rather in the beginning lose that way than to be taking trades that gave you no shot. What do I mean by that? Okay, let's say you were here and the market's going bullish. You think that it's going to break all the way out. You think it's going to continue. That's a bad buy. Why is that a bad buy? It's a bad buy because the market is at its highest price in most recent history. You want that market to come down for you and show you an area to buy from. If you chase the breakout, you think it's going to keep going. When you've solidified this high now, you now know that this is a resistance area, aka a high. You don't want to buy from there. You want to buy from somewhere down here where the market has shown you areas of buyer strength, buyer integrity, as I like to call it. That's what you want to do. If you want to sell, you want to sell from up here. Eventually it didn't work, but that's not the problem right now. You would figure that out later by the intensity of these candles, right? You missed the detail. Maybe it's GBP across the board is all bullish. Maybe Fibonacci's or trend breaks. There's a lot of things here that I can see that would have helped us. Also, I'm kind of cheating because we trade this chart in the group and I remember this very well. So I know what we did. Pretty much what I'm trying to say to you here is in these four phases that you're going to start looking for, in the trending, in the breakout, you want to gravitate more towards the higher possibility or probability of retracement, which is this one. This is trend. This is retracement. Okay, trend, retracement, trend, retracement, trend, retracement. Now those retracements are creating higher lows, which continue that trend. Okay, so that's that. I want to make sure that I make that very clear. Let's hit another chart. So this is Euro JPY. I'm going to bring it to the 4 hour. Right now, I'm not really doing a huge technical analysis. That's not what we're doing right now. We're learning the phases, okay? Here, what do we obviously see? This thing has been trending like crazy, all right, bullishly. We could see the strength of it. All right, a bunch of higher highs, followed by some higher lows. It's trending. All right. Now, we know it's trending. How else can we tell? Something called a trend line. Right? You take your line tool. All right. Now, a simple rule for a trend line or any kind of line that you draw support and resistance, trend lines, higher highs, lower lows, is you want to have as many touches of interaction as possible. I aim for 3 and up. That is my personal rule. Okay. Now, as you can see, though, this market eventually gave a retracement and then continued the trend. Now, you got to ask yourself, why here? Why did it stop? Why did the market, it should have been bearish. Why did it stop? Well, because on the higher frame, what is this? Bullish. I just taught you something. What did I just teach you? You don't want to make decisions here. You want to make decisions here. Remember how I just told you don't want to fight the pressure of the market. You want to go with the current of the market. Look at this market. What do you think you should be doing? When you look at a daily on Euro JPY, what makes the most sense to you? Bullish, right? What is this market doing? What did I just tell you before? If it creates higher lows, you should tip towards bullish. Bullish. This market is bullish. Yes, there was a retracement, but if I bring it down, if I bring it up to a daily, I don't even see this thing. What else do I see on the daily? What did I tell you in the previous video? How the market closes is what matters, right? Look at this daily candle. What do we see at the bottom? A wick. What did I tell you in the previous video? When there's a wick, it tells you there's weakness to the downside. The wick is on the bottom. There's weakness to the downside, which is a good precursor to bullishness. That's why we don't skip videos. We make sure we're paying attention, right? Even though the course is free, he's still giving us sauce. He's still making sure that we're getting real information that can be applied in this market. All right, so that's called a false breakout. When the market gives you one of those, where are you going to get those the most? H4 and down. You're going to get the most false breakouts because the market is not, the big boy money is not on this. It's on daily, weekly, monthly. Where I make my decisions is daily, weekly, monthly. Where Jonathan, who's my co-admin and co-owner of the group, daily, weekly, monthly. Any of the students that I have that have had success, where do they make the decisions? Daily, weekly, monthly. H4 is a good chart for that middle ground, but when that market is a little confusing, for example here, higher highs, higher lows, it's bullish, all of a sudden it breaks the trend line, you stop everything and you go up a frame. You make sure that you're looking at that higher frame to justify your next move. What else don't you do? You don't chase the trend, right? Here's a good example. The market's really bearish. You're like, fuck, it's going to drop. And then, whoop, you should have stayed bullish, right? It would have helped you out. The market would have fixed it for you. I just told you that also. Staying on trend is important. Also, stopping the bleeding. Here's something else I'm going to throw at you. Let's say, for example, you were buying. And then you took another buy and this market takes you out. You don't just switch your bias just because the market went bearish. You stop everything. And you wait for it to give you a fresh, brand new signal that everything is okay again. Look at what happened. If you missed the daily signal of the wick here, that one, okay? Look at what happened days later. It started creating higher highs and higher lows again. Made it real easy to get back in this market. You just needed the patience to let that work itself out. Right? The market continued to, and then eventually it just became really easy. Bang. Real easy. It's bullish. Now, I draw boxes for support and resistance, supply and demand, and other things. I don't do the lines, but you're gonna see a lot of people use these lines right here, horizontal lines, to show support, resistance, like that. It's a preference thing. I don't like the lines. That's just me. I like, for the sake of teaching in the group, and I like the way it looks. It just keeps me comfortable. That's just the way that I approach it, and that's how I do it. But there's no difference. Some people draw perfect price, support and resistance, and that's just how they trade. Some people draw zones. Some people, they don't draw any of that. They have like it's like indicators that do it for you, which I don't agree with, because if you don't have control of your own technical analysis, then what the hell do you have control of? But that's it. All right, so we have multiple phases. Let's keep looking at this. Let's go to the daily. Let's look at the bearish market that happened. All right, now lower highs. All right, as the days were progressing, because this is a daily chart, this market was creating lower highs. Multiple candles were failing to go higher and creating solid resistance, right? A high. It was creating a high. All right, and then this thing just continued dropping, but something froze it at the bottom. Remember I told you to always check a weekly and a monthly? Look at this right here. Let's take a line here. All right, look at the support. Look, the market's been here before. Here, back in October 2017, that market went really bullish from that point. So when it came back down here and met this, it went bullish again. I'm about to teach you something that a lot of people never get told. because I don't know why. Every single concept that you're learning right now can be applied to any time frame. Okay? The market has something called structure or mechanics, give it that word. It runs in a very specific way where certain things have to happen. There's plenty of reasons why, but the main reason is just like anything else that we deal with. Real estate, the price of chips, the price of water, the price of gas. There's a low and there's a high. And in order for the market to reach a new high, it needs to totally destroy that old low. Right? So what I mean by that is this: exhaust it. So if this is my low, the market will leave, but at some point it is just market 101 that it has to come back. It doesn't have to be today. It could be years later. It will come back. Okay? Once it exhausts the amount of buying there and creates a new low, that low is no longer important to you, and now you're progressing to the new one. Give you an example? Sure. Old low. New low. Right? This is October 2000. We're in 2020 now. All right? It takes forever for these things to happen. But let me show you the same thing on a 5-minute chart. This is going to be a bitch. Actually, I'm going to go 15. I don't want to start scrolling. All right. So highs. Actually, it's... All right. So we're going to use a small example. Now, on the monthly, we're using hundreds, thousands of pips as an example. But here we're going to use this 5-minute to break down all the phases and show you that new low, old low thing that I was just talking about. So, consolidation. Breakout. Retracement. Okay. Old low. This is the old low of the consolidation. New low. Trend. Now this happened in a span of 3 hours or so. Okay. It was, or maybe less. I can't see it on my glasses and I'm kind of blind. But you get the point. The point is, whether I'm on the 5-minute chart or I'm on the 15-minute chart or I'm on the hour chart, or I'm on the daily, the weekly, or the monthly, the market will run these phases. Trending, consolidation, breakout, retracement, right? Creation of old lows, new lows, aka higher lows for bullishness, lower lows, 1 low, 2 lows, lower highs for bearishness, 1 high, 2 highs, 3 highs, right? The difference is how fast is it happening and how many pips am I getting. On this trend right here, how many pips is this? What is that? 80 pips. On the trend we were looking at before on the monthly, let me just look at this one little leg right here. 1,120 pips. There's your difference. What else is your difference? Bigger moves take much longer. Think about it like a rubber band. Think about it like any kind of, you know what we can use? Bitcoin. For those of you who are not familiar with Bitcoin, Bitcoin was a slow grow, okay? Again, think of it like a rubber band. The people in the beginning, the ones in the know, the Warren Buffetts of the world, the Gustavos of the world, the people who are into this type of stuff, they start pulling that rubber band back. They don't know how far this rubber band's going to stretch, but as they're pulling that rubber band back, the retracement, it is getting more and more people to jump on this, right? To buy the dip. And then eventually enough people get on this thing that it's worth to release that rubber band, and then you get huge trends. The more buyer pressure or seller pressure, the bigger the trend. Where are you going to get the most buyers and sellers to enter this market? Those higher frames. Why? Time to realize these things. Also, to get better prices. If you go into a store All right, back to the chart. And you know, let's say this chart was kettle chips, jalapeno kettle chips, my favorite chips, okay? Let's say this chart was showing you the currency of jalapeno kettle chips. And you saw that jalapeno kettle chips, which you love and want to invest in, back in 2016, but let's say it was back in Monday, it was $1.14 or whatever for the chips. $1. The chips are $1. And then everybody and their mother knows Gustavo is loving kettle chips. He's investing in kettle chips. They're going to invest too, which pushes the price up. Okay, cool. And then you tell your cousin about it. Your cousin would be a moron to buy the chips up here. Your cousin has to hope that the market comes back down to $1 so that he can also buy the chips at the same price that you bought it at. Now, the beauty of Forex is that you can take profit on what you've acquired and make some of that money and double dip when it comes back down. You can do that on a 5-minute for the faster moves. You can do that on an hourly for the faster moves. You can do that on the 4-hour and the daily for the day in, day out moves. The point is that you have to embrace the fact that the market is going to retrace back to a price where it started. That's the point. What you don't want to do is you go into a store and you're like, hey, let me get that water. It's $1, man. Oh, fuck, I forgot my wallet. You go back outside to the car to go get your wallet. You walk back in the store and the guy's like, well, man, I mean, it was $1 about 10 minutes ago, but right now it's $1.25. You still want it? What are you going to do? No, because you think he's playing you on the price. Well, guess what? That guy behind the counter, that's the market. Let's go to a 15-minute chart. Let's say we're here. All right, let's zoom this in a little bit and let's bring this to screen. Let's say we're here. All right, right here. I walk into the store. The water that I wanted, right? Fuck, I forgot my wallet. When I come back from the car, the water's up here. It's more expensive. Do I buy it? No, I embrace the retracement. Back to a low, a price where the market's been and solidified a low. That is what you have to start working on. Price. On your screen, I told you the most important thing is the candles. Candles. That's what matters to you. What are the candles? This. The right side of your screen. Price. The candles on your screen are telling you the movement of price. When you look at those candles, it's basically a symbol kind of making it easier without all the numbers being chucked at you. It's no different than you seeing the fluctuation of your weight, or if you ever had a job in retail. I remember when I worked for fucking Radio Shack, they would give you these graphs showing you your productivity Monday to Thursday, Monday to Friday, how many phones you sold, when you sell most accessories. So you're able to kind of digest those numbers way easier. It's easier to read. That's what the candles do for you. That's what line charts do for you. That's what these horizontal lines for support and resistance, for you to be able to see how prices acted at that price before. That's what the boxes do for you. That's what looking for these little patterns, that's what that does for you. What I'm trying to tell you here is something pretty simple. When you are breaking down these charts, there is no stronger weapon than price. That is called price action. That is what we're talking about right now. Price action. If you're going to Google anything, Google price action. If you're going to get any books, get them on price action. There's a lot of boring shit out there. I would recommend you kind of surviving that boring shit. It has its importance. I focus on price action. I am just really good at that. I'm good at the detail breaks. I'm good at just understanding timing in the market. Again, experience. You get that inner timing mechanism that only experience can teach. You know, I think that in this world, we kind of try to fast forward things way too much. That microwave mentality. Look, at the end of the day, why am I so comfortable in giving you free information? Why am I doing that? Because I know how hard this is. I know that you could take in all these videos and you could understand everything I said, and the market's still going to wash you. The market's still going to smack you up and down because you have no experience. So when you start trading, don't be deflated by the fact that you may lose, or you are going to lose trades. It's going to happen. You're always going to be susceptible to losing. I still lose to this day. There is no perfection in this market. It does not exist. Don't let people lie to you. I promise you, if somebody was perfect in the market and had a 93%, 97%, 99% win ratio every single week, guess what? Banks and the hedge funds will be they'll find out. You know how I know? Because I've gotten the emails. I've gotten the calls, right? I've gotten the calls from people wanting my skill set. Not going to do it, but if I'm getting those calls, then that perfect 100%, 95% every single day, every single week guy, I mean, he's getting those calls and they're getting harassed, and they might even threaten the mom with shooting her in between the fucking eyes if this person doesn't work for them, because that's unheard of. A perfect Forex trading history is unheard of. A perfect stock history is unheard of. It doesn't happen because there's so many variables to this. That's why it's so important to manage your profits, right? Take the money, right? When you hit a target, take some money, right? When you lose, cut the trade, right? Live to trade another day. These are all very important things. Now, is there more to price action? Yes, there is, and we're going to cover that now.